Ever wonder how insurance companies actually manage to pay out claims, especially the big ones? The answer lies in the economics of claims reserves and payouts. In property and casualty insurance, reserves are the financial backbone of every insurer's operations. Without them, the entire system would collapse. Let's break it down. Every time an insurance company writes a policy, whether it's auto, homeowners, workers' comp, or commercial liability, it's making a promise to pay future claims. But those claims don't come in all at once, and many don't get resolved for months or even years. That's where claims reserves come in. Claims reserves are liabilities that insurers set aside on their balance sheet to account for expected future payments on reported and unreported claims. These reserves are not nice to have. They're a legal requirement and a central part of financial reporting, solvency monitoring, and rate-making. There are two major components to reserves: case reserves, amounts set aside for known claims based on adjuster evaluations, historical data, and expert judgment. Incurred but not reported, IBNR, reserves, a more complex component for losses that have occurred but haven't yet been reported. This includes everything from latent injuries to slow-developing weather claims. Insurers rely on actuaries to estimate these reserves accurately. The process involves analyzing historical claims patterns, severity trends, inflation, legal environment, and even social factors like litigation activity. These aren't static numbers. They're constantly updated as new information emerges. Now here's where the economics come in. Because P&C insurers collect premiums before claims are paid, they have the opportunity to invest the float, that is, the money sitting in reserves, into income-generating assets like bonds. That investment income is a critical part of an insurer's profitability. So setting reserves too conservatively means locking up excess capital that could be invested. But under-reserving puts the company at risk of being unable to pay future claims. Striking the right balance is key. Take, for example, a commercial auto insurer. If large verdicts and legal settlements are increasing, the company may need to raise reserves across the board, even if claims haven't spiked yet, because severity expectations are rising. That increase in reserves can reduce reported profits in the short term, but is necessary to maintain solvency and trust. And what happens when claims are actually paid? The insurer draws down from those reserves. If the reserves were too low, it must record a loss adjustment, sometimes impacting its earnings or even its AM Best rating. If the reserves were too high, that excess may be released, boosting earnings but also triggering regulatory scrutiny if done too aggressively. The role of regulators and rating agencies is to make sure these reserves are sufficient and accurate. Under-reserving was a major contributor to past insurance company failures, especially in long-tail lines like general liability or workers' comp. In short, reserves and payouts are a balancing act between predicting the future, managing capital, and complying with regulation, all while ensuring claims are paid fairly and efficiently. Looking ahead, advances in AI, predictive analytics, and automation are helping insurers model reserve needs more accurately. But the core challenge remains the same. How do you price and fund a risk today that might not be fully understood or paid out until years from now? If you found this helpful, give it a like, subscribe to Insur Knowledge, and drop a comment with your biggest insurance question. We break down P&C insurance so it actually makes sense, whether you're just curious or building your career. More episodes coming soon.